how do you solve a problem like asset allocation? And by that I mean, how do you know whether to invest in European equities, UK equities, or bonds? It's the biggest problem facing all DIY investors and professional investors. What happens is they start with a blank piece of paper, and then they're normally bamboozled by any researchers that's out there, and then they become confused and end up probably buying the wrong thing or don't even know what to do or where to start. So we wanted to be ambitious. We wanted to solve that problem for DIY investors. So how we solved it is via our best of the best selection. And you may recall when in the previous video we showed you what this is. This is our we look at our best of the rest, so all the funds that are identified as having strong momentum trends right now, we've screened out on a risk adjusted basis. Now, what we do is we then bring some of the very best ideas into our 80/20 portfolio, and then we get all of those best ideas and we put them on the table essentially, and then we look at how they actually generate those returns. How has the fund performed over time, and in doing so, and how those returns have been achieved, we can give them a risk profile, and that risk profiling is unique to 80/20 investor. So it means that no two funds that can be in the same sector that the IMA categorise them, say property, can be very different. So it could be some property funds invest in buildings and offices, for example, others in shares of companies that deal in the property market. They're very different animals. You can see one is essentially a share and the other is a property. So what we do is rather than lump them together, which everybody else does, we thought, well, let's actually look at these funds as individual entities and then we can give them a risk profile. What it means for your asset allocation is that people who stick to the 80/20 portfolio, in the lower risk section, as you can see there, we've identified some opportunities that exist in these particular categories. So it could be global bonds, and then we open that up and we'll go, for example, there's two there, global macro bond, and that one is actually based, will be because I know that fund in particular as a good is a bit of a bet on a strong dollar. That's why that's pulled through, and it's had a strong upward trend that's been very stable. And also it's got a bond, had a kicker from the bonds where bond yields have been falling. But so you can see that that's come into the lower risk area, but that will change in the future as the markets change and macroeconomics and everything changes. Things will drop in and out of these risk buckets. They're not guaranteed. For example, you go through, you'll see there is no UK oil companies in here at the moment. There's no UK equities, and that's because the trend at the moment for UK equities is quite down. There isn't the exciting opportunities for momentum at the moment. So, but when there are, it will drop in here somewhere, and where it will drop in will depend on the particular fund that's been identified as having the great opportunity, and it will go into whether it be medium or even high risk, depending on how they invest. And you can see that you can therefore have funds in the same sector. We group them by the IMA sector titles for ease of use and for you to see them. But they can actually appear, for example, in two different sections, different funds in each section because they invest very differently. But you can see that two funds in the same sector can appear in the 80/20 portfolio, but different areas. And you can see Europe equities. Lots of people would think that European equities are more medium risk, but some of the funds, and the ones we've identified here, will invest in perhaps some of the smaller companies out there or areas that make them slightly more high risk, but that's the best way to categorise them. So what you can see is that the allocation of our portfolio ranges and it changes. You can have greater exposure to bond funds. There's not always the same number in the lower risk, medium risk or high risk. It's if the opportunities arise. So you can see that it's a fluid animal. It's always changing, and you'll never get overexposure to one area because we limit the amount of exposure you can get. You won't just have all American funds. We actually limit it down to actually make the thing diverse. But then taking it one step further, let's just imagine you decided you were into global and you came in here and you saw the 80/20 portfolio and you thought, look, global opportunities, there are definitely some opportunities in global funds, but I want a few more than that. I want to see what others are out there. If you go across here to it's labelled sector data, but also it's called our 80/20 best of the rest area. It will take you through to all of the funds that we've identified using our 80/20 algorithm of having a positive, stable, risk-adjusted momentum trend. And obviously the 80/20 portfolio is based on unit trust, and you can see we start off in the unit trust tab. So you can see there's some opportunities there. But you may decide you want to look at some of the investment trust alternatives, and you go into the section there for global, the equivalent, and you can see some opportunities there. And it's a way, and then we've got ETFs, of course, and it's a great way of you being able to explore DIY investing. Plus, you can use the tool to automatically asset allocate or even use it to build your own portfolios.